Looking to build, looking to buy, maybe looking to refinance? Is now the time? Mortgage rates went up a little bit today. So what are we expecting kind of next week, or what happened this week? That's what we're going to talk about in today's video. So mortgage rates went up a little bit today. The stock market had a fantastic day, but the bad news is a lot of this was good economic news that came out, and that took money away from the bond market, sending interest rates up today. So my name is Dan Frio. I do this report actually 2 times a day, inform you guys what in the heck's going on with these things and your financing options. And our slogan here is one application, one credit pool. We're going to shop your mortgage loan to over 30 different lenders. How do we do that? Give you that information at the end of this video because we're trying to figure out what's going on with these things. So let's get to today's economic calendar. We're going to basically just do a weekend review. And the reason behind this is we got the Federal Reserve coming out in 4 days. I'll get that out of there. We got the Federal Reserve coming out in 4 days. They're going to tell us what they're going to do. Well, the probabilities of what they're going to do are all over the map now. Let's get to this thing right through here. Here's the probabilities of what's going to happen over the next few meetings. I'll get my head out of the way so you can see the whole index. So this is where we're expecting the Federal Reserve to go over the next meetings throughout the next year. And here's the federal funds rate right across the top. There's a 96% chance they're going to do nothing at this meeting. Well, here's the wild thing is this was about 59% just yesterday. Now we've got a 34% chance or a 64% chance that they're going to do nothing at the next meeting as well. So it doesn't look like the Federal Reserve is going to do anything at the next few meetings. The reason behind that is the economic news. We keep getting better and better data about the economy. Now, the mainstream media keeps wanting you to hear everything is terribly wrong. Let's just take a recap of what happened this week, and then I'll give you my thoughts on what's going to happen next week. But first, let's figure out why what happened this week actually happened. So let's get over to it. Here's the economic news that we want to go through. On Tuesday, here's the data we had. We had the JOLT index. Now, the JOLT index is job openings and labor transfers. The number previously was 7.48. It was supposed to stay at 7.48 or 7.49. It actually went down a little bit to 7.19. Not a bad number. Let me get my head out of the way so you can see the rest of these things. And here's what I want you to understand. The better these numbers are, well, the more likely the Federal Reserve is not going to cut, because this is telling us, well, we got a robust economy, so we don't really have to do anything to stimulate it anymore until we see the tariffs really taking a bite into things, and then we'll react at that point. So we had ADP payroll numbers, and I told you I hate their numbers because they're not very accurate. So I'll get to this in a second, but they came in at basically projecting half of what was, they projected 114,000 new jobs being created, and it came in about half that, what they say. Okay, so I usually throw that out. We had GDP. It actually crashed from 2.4. It was supposed to stay at a positive 2, and it went down to a negative 0.3. So that means the economy there it's not in good shape. Now, here's the inflation piece of the puzzle we had right through here. PCE. Now, this is the inflation number that the Federal Reserve puts the most weight on. Let me scooch that in so you can see it. PCE. 3% previously. They expected it to come in at 2.6. It came in right at point. That's year over year. Okay, but now here's what we have. The core PCE month over month. It was a 0.5% previously. It was supposed to go down to 0.1. It went basically zero. Zero core inflation. That means inflation is actually plummeting right now, folks. And don't trust me on this. Here's the numbers. Okay, so then you go to Thursday. We had initial jobless claims. They were kind of a little bit right in line, say, to where things were. I won't say they're really way off, but they were somewhat close. Then we had the manufacturing numbers came in. They came in at a point. Everything, the rest of the numbers came in pretty nicely. And then Friday, here's what we got. And then we got this non-farm payroll number. The expected 138. Came in at 177, more than projected, and not much less than previous. This is where I say go through ADP, and you go to their number, and they projected it came in half. And I'm going to keep throwing their numbers out with the bathwater. Then you had the unemployment rate staying sticky at 4.2. And the reason why I'm saying all this is right through here. What the Federal Reserve is going to look at when they come to their meeting is right through here. We have the PCE, the unemployment rate, and the GDP numbers. Well, all those numbers came in this week on our calendar. And they came in pretty darn good, other than the GDP just falling off a cliff. And we'll see how that goes over time. But inflation's coming back down in check. We had the last couple readings coming down. This is where they want us to be at 2. We're smidgens away from that. Got the unemployment rate that's staying sticky right here. They expected this to maybe go to 5%, and it's staying healthy. We got the wage data coming in, and it's healthy. And that's what's causing this right through here. So you're seeing a lot of people saying now, well, maybe the economy isn't as bad as people were telling us. Maybe the tariffs aren't going to be as bad for us as they think. So now money's moving back into the equity markets. What happens when that happens? Well, when good news comes out, especially now that we have, well, the Federal Reserve's not going to cut because of the good news. And then we have money pulling out of bonds, most likely moving back in the stock market. Well, this is what you're going to have. I don't know. My thoughts are, I don't think this is going to be long-lived. We just have we need a little bit more good information on the national budget. But let's get over to Rick Santelli, because there was a reaction in the bond market. Here's what it is. Let's see what he has to say. And this was latter part of the day. It wasn't the opening bell. So let's hear what he says kind of midday. And he's here in Chicago, Illinois, right with me. And he actually just lives at the town north of me. So if anybody knows him, I'd love to meet the guy. But let's get over to Rick over at CNBC.
In the meantime, bond yields are jumping on economic and trade optimism today. Rick Santelli, he is in Chicago, jelly bean free. And, we're not trying to make too much of these markets being up. But, Rick, you got to admit, even for Rick Santelli, this has been a pretty unbelievable comeback the last couple weeks.
Not for me. Sorry.
That's why I said not for Rick.
I think it was on this show, actually. I think it was on this show where I talked to you and Kelly and said I would be dipping my toe in about 3 weeks ago. Listen, to me, I agree with the last guest wholeheartedly. All the adages, Farmers Trading Almanac, toss it all. You know what? It was a man-made event, and I sincerely believe that all the green in the markets is much smarter than all the naysayers in the economic community. Let's look at a 2-day of 2s and a 2-day of 10s on the same chart. Couple things should jump out at you. First of all, yesterday we broke an important streak you need to be aware of. We had 5 lower closes in 2-year. That ended. We had 7 lower closing yields in 10-year. That ended. So there is a turnaround going. And when you get a turnaround like that and you get the kind of upside that you see on those 2 charts, we're up 5 basis points right now we're up 12 basis points in a 2-year. We are now up 9 basis points in a 10-year. Now let's move to the weekly charts. Also very important. Coming in today, I thought it would be really tough to turn the weekly numbers up, but that's exactly what we did. We settled at 370 last week, 375 last week. So look at what we've done. And in a 10-year, we settled at, 431-ish? Right now we're trading, but we're at 424. So 320.75 and 424, up 5, up 7 on the week. Didn't think we'd see it. And it wasn't only the 830 data on the jobs report, Brian. Even though we lost 58,000 on revisions, it was a solid report. But at 10 o'clock, we also really held on to some of the gains in factory orders and in durable goods. And even though a lot of it was aircraft, if you look at the charts there at 10 o'clock Eastern, we started to build on the upside again. These are aggressive closes, and I contend that the statement for the 10-year for the rest of the year is not going to spend much time under 4%, in my opinion. Back to you.
Rick Santelli, you did say put the toe in. Appreciate it.
Okay, so that's the point. If you've ever spoken with me, I always say, or you watch my videos, I'm like, okay, we were waiting for that turning point, and I think we might have gotten it today. So what I did earlier this morning, when the bell opened, I saw this. We cracked an area over here. I won't give all my tricks away, but we cracked an area right through here. So I locked anybody that is 30 days or within 30 days of closing. We locked you in. The reason why we didn't lock anybody in if they're over 30 days is there's not much of a revision in here. You could see this chart looks like It's crazy, but that's the difference in the rate, 0.07. So right now I'm saying, okay, we're going to hold off right now because, even if we go on a 45-day lock, I can get you a better rate on a 30-day lock, even if rates ticked a little bit higher from here. So if you're confused on that, I hope you are. And that's why people should reach out to me and let me help them out with all this stuff. So that's what we've seen over here. What next week's going to be all about is going to be basically the Federal Reserve. They're going to come out and they're going to, that's what it's going to be in tariff trades. The Federal Reserve's not going to do anything, folks. So as this news comes out, the markets are going to move really volatile. We have in our favor right now, we have inflation on a lot of other pieces of the puzzle, like food, energy, wage. We even had wage growth, unfortunately, reduced a little bit today. So that's kind of in a sweet spot for the economy. So, not all things are terrible at this moment. So the bad news is, as more and more better news comes out, you're going to have the Federal Reserve saying, man, we're going to hold off. So that's going to have people move their monies into the stock market and out of bonds, putting more pressure on rates. So we'll be coming in on Monday, focusing in on the tariff trades, more and more data of, Trump and the Federal Reserve arguing about things. We'll focus in on that on Monday. That'll be our most important things for that. So now getting over to me and what I do and how I do things, we keep revamping our website. But we have a slogan here. It's one application, one credit pool. We're going to shop your loan over 30 different lenders. Now, why do we say that? And what actually do I do? Well, I'm actually a federally licensed mortgage loan officer. So that means I'm licensed in all 50 states as well as Puerto Rico. But the really cool thing about the federal bank that I work with is I can be your loan officer, and we're set up with our bank and 34 other banks basically in the background. So by applying in my website, we have that slogan, one application, one credit pool. We're going to shop your loan over 30 different lenders. That's how we do it. So we can navigate you through the initial process of getting you quotes and everything. We can also use their programs. We have programs on boutique programs, like we do reverse mortgages, investor loans, DSCR loans, stated income loans, believe it or not, are kind of back. And those are the options that we have for you. But the cool thing about this is we can shop your loan, meaning your interest rates and your fees, to over 30 different lenders. Now, if you have the ability to do this, God bless, folks, do it yourself. My goal is to help those younger people out there, or the people that just like, Dan, I don't know what I'm doing. Can you please help me? Those are the ones I really love to help. So reach out to us at therateupdate.com. Right over my head, you can put in your application. Once you do that, we don't pull your credit. I'll be reaching out to you to answer any questions that you have before we move forward. Or you can schedule a one-on-one consultation. This is working now, and me and Alan are right up there on there. So schedule an appointment with me or Alan, or you can give us a call at 844-775-5626. You can ask for me or Alan. Both of us would love to help you. But check out also some of the videos that we've been adding down here on a weekly basis in regards to, we have over 3,000 videos on YouTube, folks. So here's a few of the hand-picked ones that we have that hopefully will help you out the most if you're watching this video. So thanks for watching, folks. I will be back next week with some guidance, but short term, I'm locking in everybody that's under 30 days from closing, and long term, I'm floating into Monday to see where this takes direction. Is this a turn in the markets, or is it just another pivot and we'll be back up and with lower rates in the future? So check out Monday's video, and I'll give you more direction at that time. Thanks for watching, guys. God bless. And please, if you haven't subscribed yet, love for you to do so, just right over there. And I'd greatly appreciate it. Have a great weekend, folks. See you next week. Bye-bye.